years ago, global financial markets, such as the one that's behind me right now, Africa's biggest capital market, experienced the biggest crisis since the Great American Depression at the turn of the last century. Welcome to Political Capital. I'm your host, Karabole Tlhatla, and this week we reflect on a decision that was taken by the fourth biggest investment bank in the United States, the Lehman Brothers, when it filed for bankruptcy on September 15, 2008. A move that roiled up global financial markets and precipitated to wipe out nearly $10 trillion worth of global market capitalization in the following month alone. Now, the man trusted with saving South Africa from this precarious position was the governor of the Reserve Bank, Tito Mboweni. My colleague, Fifi, sat down with the man to reflect on the times then and some of the measures they had to take to avert a full blown-out crisis in South Africa.
On the 15th of September, when it was announced that Lehman Brothers had collapsed, it became clear that the world had changed, totally changed. We're in a totally different world. But what is the background to this? The background fundamentally is in the American housing market and the development and explosion of the subprime market in the United States, in the housing market, and how bankers took advantage of that to build up huge, difficult synthetic products in the market, collateralized debt obligations, and so on. And this instrument, this synthetic instruments, financial instruments, were described for a bit of time by many economists, including Alan Greenspan, as an example of how the American financial system was very dynamic and flexible. And yet, what they were building was actually a bomb that was about to explode. And one of the senior Wall Street bankers said that his bank had accumulated so much of these synthetic products that they didn't know how to unwind them. So if they could say that, it meant that we were in a very dangerous situation. So naturally it had to explode because there were no clear underlying assets to this synthetic products. And this led to Lehman Brothers collapsing, and thereafter many other things happened. Then the insurance companies, American International Group, for example, AIG was also affected. Then it spread around the world. So naturally for countries such as South Africa, the knock-on effect would immediately come through the portfolio channel. So people start withdrawing their investments in bonds or equities in order to cover their positions, which they're losing in the United States. And so it was quite a traumatic time. And the interesting part of it is that a couple of months earlier, in Basel, at the headquarters of the Bank for International Settlements, we had been discussing risk management. And it became clear to me thereafter that you can discuss risk management until the cows come home, but if there's no change in behavior in the market, you'll never be able to conquer that beast. So, as I said at the beginning, the world changed, I think, on the 15th of September 2008. And now the question can be asked, why was the situation the case that South African banks were not as heavily affected? And the simple answer is that we did not allow some of those products to be traded here because we didn't understand them. My basic approach was a basic Zanini approach. If I don't understand something, I cannot give approval for it. Thank God I didn't understand the damn thing. And so growing up in Zanini helps because you're kind of slower, you know, in understanding these complex issues. But it saves the situation.
A lot of people that I'm speaking with say that these unconventional monetary policies that were adopted, no one really knows what the real impact or what the real outcome of them will be, because this is untested ground.
No, we know that. We know that. We know that the over relaxation of monetary conditions has certain consequences. We know that. We can model that. Whether you're looking at the monetary conditions index, which will show you the impact of what quantitative easing means, its impact on the monetary conditions, on interest rates, on what happens to lending and borrowing. We know all of that. So therefore the sucking out or sucking up of liquidity from the system is the normalization process which should happen. And central banks are very central to the process. But this has to be done in conjunction with the fiscal authorities, which has got impact on the tax system, it's got impact on public expenditure, and so on. We know all of that. So the normalization of the monetary conditions in the United States and in Europe should come as no surprise at all. This was going to happen. It's a normalization process. The question what happens is, under normal circumstances, there will always be interest rate differences amongst and between countries. So for South Africa, for example, the decisions of the Federal Reserve Banks Federal Open Market Committee is very important, because it then might establish the differential interest rate between South Africa and the United States. Now, when that happens, naturally, the bankers would say in New York or in Boston, my client who has entrusted me with the responsibility to manage their funds expects a better return. If I'm going to get a better return for my client from investing in the US and not in the JSE because of the interest rate differential, I then pull my money out of South Africa into the United States. It's a natural system of capitalism. It's not because they hate South Africa, but they're looking at the bottom line. Where am I going to make a better return for my client? So those interest rate movements are very important, and the bankers look at that every day very carefully in order to optimize their clients' investments. It's not, so if you do foolish things in South Africa, which result in maybe the interest rate differential between the US and South Africa being so wide, clearly you should expect investments to move out of South Africa into the United States. You have to understand the logic of capitalism if you are to manage a country in this modern age. If you don't understand the logic of capitalism and you think you can just appeal on the spirit of support for the new South Africa, blah, 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 I think you live in a fool's paradise.
I mean, these unconventional monetary policies that were adopted at the time of the crisis, you even said that Japan had been doing it way before. Then what was the impact on our monetary policy? What did it mean for our interest rates at that time, or how the decisions that you made at the time?
We were guided by the monetary policy framework of South Africa, which is inflation targeting. So we focused on that, and we didn't take our eye off the ball. That's number one. Number two, we had to make sure that our regulatory framework for the banking sector stayed in place. So that's what was guiding us. And we had to make a regular assessment about how we are doing in that regard. Nothing overly dramatic. Too much liquidity in the US, Europe, and Japan. Naturally, that liquidity had to find its way where it can make a better return, and South Africa was one of them. But in terms of our monetary policy focus, we stayed focused on inflation targeting, and we stayed focused on making sure that our banking sector remains stable. Therefore, the regulatory framework had to be in place, and our payment systems in place, and that's what happened. And we were able to, with the benefit of hindsight, I think we did the correct thing.
Your conversations with the banking CEOs at that time, because their clients were worried. You had the JSE who had to restore calm because of the selling that was happening on banking financial stocks and what was happening to the rand. I mean, I'm just interested in the kind of messaging that was exchanged between you and the sector.
Very, very simple. Stay calm. Don't show any panic. The test of any good CEO of a bank is whether they can stay calm when the seas are rough. And the test of a good central banker is that you never show any panic, even in difficult times. You show lots of confidence, even when it's tough. That's what you do. So naturally, there are regular conversations between the governor of the central bank and the CEOs of the private banks, one-on-one, or in the group, or whatever the case is. A central bank governor must always be in touch with the CEOs of the private banks, but also with the chairpersons of the boards of directors of the private banks, to make sure that we close all the loopholes. That is the pleasure of central banking. But I don't miss it, by the way. I'm very happy to be a pensioner.
Oh, just as we close the conversation and we really bring it to South Africa specifically, and some of the challenges that we're facing, you mentioned the logic of capitalism and how it doesn't matter whether you're coming with a new dawn or new dispensation messaging, there's a logic to capitalism. I'm interested in your assessment of where we are going as a country and our attempts to emerge from a recession. Now, what needs to be done?
The tasks before the government are very simple, in my view. One, we need an appreciation of the nature of South African society. What kind of a society is this? Well, in terms of stats, South Africa, we now live in a situation where about 62% of the South African population lives in urban or peri-urban areas. So what does that mean? These are not farmers, not peasants. So you can shout about land, this and so on. These are not peasants. These are peri-urban and urban people. They have a different lifestyle. And so the source of growth in the economy must also be scientifically based on what material we have. So this doesn't sound very nice, but the reality is You know, the kids who were born in 1994 or 95 were called the born frees. Actually only graduated last year from university. That's the reality. They graduated last year. So what does it mean? It means that because of the changed structure of the South African economy, where over 60% of GDP is the tertiary sector, is these kids who graduated last year who need to be absorbed medical services, legal services, banking and finance, municipal services, community services, government services, and so on. And the financial sector has to be the natural place where a bulk of these youngsters are absorbed. And as a government, the key question you need to ask yourselves is, are we in a position to create at least two things? Johannesburg as an international financial center, not something, I'm sorry to say that, Johannesburg as an international financial sector. What does it mean? It means you have to have a different tax dispensation for Johannesburg as an international financial center. Suddenly that will create financial services in Johannesburg. It will create restaurants and retail trade and all kinds of things. Tailors who are going to make suits for you and other people. Something is going to happen.
A higher tax?
Secondly, lower tax. That's what you need to do. Secondly, which is unpopular, what I'm going to say, you have to cut down the civil service. And smaller in number, better remunerated, and the savings that you're going to make from that, you plow it into public works, infrastructure.
When we return, the former Reserve Bank governor discusses some of the current economic predicaments facing South Africa. Welcome back to Political Capital, the intersection of money and power. South Africa is in a precarious position following 2 consecutive contractions of its GDP output and an unemployment number that now stands at 27.2%. But there was a time when South Africa was growing at nearly 6% per annum. But where were the jobs? Here's a bit of the rest of their conversation that my colleague Fifi had with former Reserve Bank Governor Tito Mboweni.
The one thing that administration of Thabo Mbeki is criticized for is it wasn't that we had the economy growing, we had businesses making money, but then afterwards we weren't growing inclusively, we weren't creating the jobs that we needed to. So in this, as inclusive growth or radical economic transformation, however you want to see it, I mean, for business to have an environment in which it feels comfortable to help grow the economy and to make profit, I mean, how does business balance that scale better to ensure that, you know, it doesn't repeat, and even government doesn't repeat the same thing that happened 10 years or so ago, whereby the economy grew but not for the benefit of all?
You see, the pig farming I'm talking about, and the chicken farming. So don't wait for the government to create the pig farm for you. So don't wait for the government to include you in the growth, when you can actually do the pig farming, the chicken farming. Everybody has eggs every morning. So the full understanding of context is very important. And the full understanding of the structure of the South African economy and its changing nature is very important. I mentioned earlier that the post-apartheid kids only graduated last year. So what we were dealing with all along were actually the products and remnants of the apartheid system. That's what you were dealing with, and you need to understand that. It's only in about 10, 15 years that we can judge whether this cohort that graduated last year, being the first post-apartheid kids, are they going to enter into the economy that I described earlier? Now, I mean, I can say with pride and arrogance that we did much better. At some stage, we hit a 6% growth rate in the economy. We did well. So the challenge for those who have taken over government from us is whether they can unlock all the levers of the economy to be able to reach at least a 3.5% growth rate. And I'll be criticized for saying this, I think that the government should, or the ANC, should consider bringing 2 or 3 private sector people into the cabinet. One to be Minister of Trade and Industry, the other to be Minister of Agriculture, a person who understands the agricultural sector, and the other to be Minister of Infrastructure. Private sector people who know how to run a business.
Anyone in mind?
Yes, I have 3 in mind, yes.
Who are they?
No, I can't tell you that. Myself excluded, obviously.
But in bringing these individuals, what will we likely see?
We've seen before throughout the world that when you infuse private sector skills into the government system, there is a new dynamism, because there's a conversation between the politicians and the private sector people who get things done. And it has helped. Throughout the world, I've seen how smart presidents actually bring in private sector people to work with them. It helps. But I also know that if you identified a number of trade unionists who also understand the dynamics of business and the workplace, it helps. We had, in our cabinet, we had Jay Naidu, who was the General Secretary of COSATU. We had Alec Ewen, who used to be the Education Officer at COSATU. And then I brought in to the Department of Labor Les Kettledas, who used to be an organizer at the Metal Workers Union. And then we had Derek Keys from the private sector. We had Chris Liebenberg from the private sector. And the dynamism that we created, and the sense of hope and the confidence. Let me give you an example, by the way. I see sometimes these young people keep on saying, you people didn't do anything, you've not done nothing for us, blah, blah, blah. Non-inclusive growth, that's what the thing you were telling me just now. And people forget where we were in 1994. Let me give you 2 examples. We were running a net open foreign currency position of close on $25 billion. Secondly, we had a 2-currency system, commercial rand and financial rand. People forget these things, that we had to put in place a system so that we have 1 currency. By the time I left the bank in 2009, the net open foreign currency position was gone. And we had reserves of close on $50 billion. And then somebody stands up and says, these old farts haven't done anything. Ahistorical, non-factual, uneducated, ignorant positions. And I suppose it's one of the tasks of people like yourself and others to remind people. The other day, tongue-in-cheek, I said, do you know the N1 North that goes all the way to Zimbabwe? This thing wasn't there. We constructed it. From here to Polokwane, we used to use the R101. Then we constructed from scratch this N1 North. A very big project. We extended the N3 to Durban. Extended the N4 to Maputo, the Nelspruit and Maputo. And then extended that N4. It goes all the way past Rustenburg to Namibia. When I returned to South Africa in 1990, Oliver Tambo International Airport was called Jan Smuts Airport. It was a pitiful little airport. We extended it. We built a new airport, King Shaka Airport. We extended Cape Town Airport. And somebody stands up and says, you guys have not done anything. Now, there have been many things which we could have done better. For example, the management of hospitals could have been done better. But that's a topic for another day.
We are back on your screens on Tuesday at 6:30 Central African Time as we continue to follow up some of the testimony that will be laid bare at the State Capture Commission. Until then, good evening.